span p content div, it is equal to div GPT, line height, 0px, font size, 0px. The second quarter results of the Indian corporate sector have started showing some signs of stability, attributable to declining negative impact of the goods and services tax, GST, and the festive season, according to credit rating body Icra. According to the agency's research, the aggregate revenues of 485 companies grew by February 4% in Q2 FY 2018, compared to 6.7% in the first quarter of the year, despite many sectors reporting sequential improvement. However, even as revenue growth remained muted, the aggregate EBITDA margins of corporate sector reverted to 17.7%, aided primarily by benefits of operating leverage, i.e., higher volume growth across sectors. Document right, if ICICI banner is equal to free and displaycon banner is equal to 1, document right, good-lettered CMD push, function, good-lettered define out of page slot, /65162339 out of page _1x1 desktop, div GPT add 1490771277198 add service, good-lettered pubards, enable sync rendering, good-lettered enable services. The positive trend became visible as the transitory impact of GST implementation began to abate. This, coupled with the early onset of the festive season and improved consumer demand, both in urban and rural markets, supported recovery process across sectors. Even though margin expansion was limited to 12 sectors out of 30 during the quarter on YoY, on a sequential basis, most sectors reported improvement, said Subrata Ray, Senior Group Vice President, Corporate Sector Ratings, Icra. He added, largely most consumer-oriented sectors reported better performance, whereas sector-specific dynamics, like increasing competitive pressure in telecom, and regulatory hurdles in pharmaceuticals, and recovery in commodity prices, tires, airlines etc., continued to restrain earnings growth. In terms of sector-specific performance, the Icra report noted that consumer-oriented sectors such as automobiles, FMCG, consumer durables and retail witnessed a pickup in demand, backed by restocking by trade channels and also improved consumer demand. The gradual recovery in rural demand which helped companies in these sectors was the one aspect that stood out. The outlook remains promising in view of an increase in MSPs and higher agricultural output. The impact was evident in tractor sales too, which surged by 16% in FY 2018, driven by strong Rabi-led cash flows, a favorable impact of farm loan waiver in select states and replacement-driven demand in North India. Entry-level motorcycle segment, another barometer of rural trend, also showed positive trend during the current financial year after dismal performance over the past few years. As a result of improved consumer demand, most companies across consumer-oriented sectors reported improvement in operating margins during the quarter. Earnings growth was also supported by fairly stable input material costs for select companies, and cost reduction measures including calibrated spending on advertising and marketing. The sectors where earnings have been under pressure for past few quarters include telecom, pharmaceuticals, airlines, tires, real estate and shipping.